Hello, everyone. Thank you so much for joining us today. I'm Marcia Butler, the webinar director here at Advice Chaser. We're so glad you're here. Before we introduce our guests and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And let me go ahead and turn that on so that you can do that. All right. The presenter will answer those queries during or after the webinar today as appropriate. And if you ask a question in the chat box, go ahead and leave your phone number as well. And we're happy to reach out to you after today's event to make sure that question gets addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd like to introduce you to our presenter today. Darcy Smoot is a principal with Nelson Capital. She has extensive experience in equity analysis and securities trading. Darcy graduated with a BA from Swarthmore College, majoring in mathematics and English literature. She began her career at Bloomberg LP in New York City, and in 2009 went to work as an equity derivative sales trader at Susquehanna International Group before joining Nelson Capital in 2014. Darcy is a chartered financial analyst and is a member of the CFA Society of San Francisco. And Darcy, I know that was a short introduction. I'm sure we'll get to know you a little better as we can do our presentation here. So I'm going to go ahead and turn over the time to you.
Thank you so much, Marcia. And I just want to give a little bit of a disclaimer that I have a cold today, so I apologize if I need to clear my throat or cough. It was important for me to be here, so I didn't want to miss it. So please excuse my voice. So today we want to talk about financial health for women. I think women have a very specific point of view, and I don't want to be exclusionary. I want to acknowledge that there are a spectrum of genders, and we are kind of focusing on some of the dynamics between heterosexual couples here, but that isn't always the case, and I think that there are still dynamics even in non-binary, heterosexual couples that apply here. So just want to preface that first. So starting with some of the industry data, I think since exiting college, I've been in a pretty male-dominated industry. So it's not terribly surprising to me, but perhaps this is surprising to everyone else that only about 15% of financial advisors are female. So certainly is a heavy male-dominated industry, and that's just kind of the history. I think that historically, men have taken the reins when it comes to financial decision-making in a household. But there are reasons to believe that is changing. For one thing, women tend to live longer than men. So the average, additional life expectancy for women in the US today, based on a McKinsey report from about 2 years ago, is about 5 years. That means that, most of the time, the woman will outlive their male partner. Over the last 5 years, we've seen about a 30% increase in married women starting to make some of those financial household decisions. So that's I think reason that we see some of that changing. And then finally, this last bullet point, 70% of women change their financial advisor within 1 year of their spouse passing away. That that was surprising to me, but when I sat back and thought about it, it kind of makes sense. If you're a woman in a relationship with a man and you have a male financial advisor who never pays attention to you, you might feel excluded in all of those conversations. And when you're the one making the decisions about your finances, you might want to, I could see you wanting to make a change. So I thought that was interesting, but probably not terribly surprising at the end of the day. So some of the other background about kind of how women view finances, women are more likely to work with a financial advisor. I think that this is certainly a generalization, but there's kind of, I guess, a little bit of more humility that women tend to possess, where they kind of recognize where their limits are as far as expertise and say, okay, here's where I need to hire some help. I think women also tend to have a more values and goals based investment style. You know, they also tend to be less risk tolerant and more focused on those life goals. And again, that kind of goes hand in hand with working with a financial advisor. I think women are, again, generally more deliberate about their investment decisions. That goes along with having a lower risk tolerance. And women tend to make decisions based on facts and data. You know, spreading risk, again, having that lower risk tolerance and wanting to diversify a bit more rather than, you know, going all in on something. I think that's more of a characteristic of women in general. And women are looking, for the most part, to invest for the long term. So rather than kind of seeing investing as something where you're placing a bet or, you know, playing roulette or something like that, women kind of think of their investment portfolio as, okay, this has got to last me my whole life. Let's look out over the long term, and that's what I want to be invested in. So the top concern, this is probably not specific to women, but definitely women as a group have these three things as their top concerns. Retirement. I think we all at some point probably hope to enter some form of retirement. And of course, that creates a period of negative net cash flow where maybe less or no money is coming in, but we still need to spend to continue our lifestyles. So of course, a top concern when you enter retirement might be, I don't want to outlive my assets. Also, with the long-term trend that we've seen of the cost of healthcare and long-term care increasing, that's sort of an unknown or a question mark, which, you know, for somebody who might be 40 or 50 years old today, but, you know, hoping and planning to live to age 90, they want to make sure that those, you know, they're able to live long and have that necessary healthcare and long-term care down the road. And then legacy and purpose. I think this kind of gets into almost a philosophical question, which is, you know, what is money for? I think that there are people who have a financial goal of wanting to leave a legacy or an inheritance to their heirs or children or grandchildren. Some people want to bounce their last check, and that's perfectly fine. I think it's really just kind of getting to know who the person is and finding out what their ultimate financial goal is and what really drives them. I think, you know, finding the right financial advisor is really, really crucial, and there are some very important things to look for. Like I mentioned earlier, and as we detail out here, most women are seeking a personal connection with an advisor. And that's because this is inherently a very personal, you know, relationship that you're establishing. I think, again, it's sort of philosophical, and I think that there are things that are, you know, goals that one person might have might be polar opposite from what somebody else might have. And at the end of the day, it has to do with, values and belief systems oftentimes. And those things are not really, hard dollars and cents often. It's much more, deep and personal. So I think, rightly so, women should seek a personal connection. I almost often make the parallel that it's kind of like a financial life coach that you're hiring when you look for a financial advisor. And there is, I have had somebody ask me before, do you ever feel like you're kind of a therapist? And it's sort of, I laughed when I was asked that question, but the answer is yes, because I think that there's that gaining that deep understanding of what drives somebody, or what's their ultimate goal that they're working towards, which is of course extremely personal. So along those lines, it's crucial to have a relationship with an advisor whom you can trust, who you respect, and who you believe is truly listening to you. Because again, you can optimize among many different outcomes, but ultimately you want to optimize on what's going to make you the happiest with, and having you feel the most comfortable. I think a financial advisor should, of course, be there for you, and particularly in those transition moments where something happens, and it could be something great. It could be a new job or a company that goes public and creates wealth sort of all of a sudden. It could also be something not so great, like a divorce or a death or something shocking that's you really need that person to be there for you. I think you also want to have an advisor who is not just going to sit back and wait for you to come to them, but rather have them reaching out to you to say, hey, it's time for us to meet. We haven't caught up on, XYZ. We need to look through your insurance and make sure you're covered there. We want to make sure you're on track with your financial goals towards, working toward whatever they are, retirement. I know that you might be taking a year off from work next year. That might be an opportune time to do XYZ from a tax perspective. So I think having a financial advisor who not only knows deeply what your goals are for the long term, but who can reach out to you and say, hey, this is something that you might not have thought of that I think would fit really well with what your goals are. So having that person know you and reach out to you proactively is, I think, very important. So I think this is a slide as women, I think a lot of us can maybe relate to this, especially those of us who've been in a more male dominated industry. If you're kind of shy, especially in a situation where there are dominant personalities kind of taking over, you might feel vulnerable or scared or nervous or shut out from those financial conversations. I skipped over shame because I think shame is something that anybody can feel, and that's probably not even gender specific, but if focusing on your finances is not something that you have time to do or have interest in, you might feel ashamed and go, oh gosh, I haven't even looked at my retirement plan in 5 years. I'm so embarrassed. I can't believe it. At my age, I haven't taken care of this. I couldn't possibly go and talk to an advisor. They're just going to laugh at me. But I think it's really important to put that shame certainly aside. I think putting aside feelings of vulnerability or nervousness are definitely harder to do. And so I do want to acknowledge that, of course, those feelings will be there. And then similarly, not feeling confident about your own financial literacy. I think the important thing to remember is that a financial advisor is someone who is there to serve you. So I can promise that if anyone is having these feelings of shame or not feeling confident, you're absolutely not alone. I think that I like to remind, people who've expressed these feelings to me, hey, this isn't your day job. You have a separate, different, very, very wonderful day job that isn't, focused on managing your finances. And that's why our jobs exist as financial advisors. And so there's nothing to be ashamed of. I think to the degree that you can, again, establish that baseline of trust with a financial advisor, that's when you can kind of feel more confident and hopefully open up some of those vulnerabilities that you might be feeling. So couple dynamics, again, I think that this is probably focused on maybe some heterosexual dynamics in couples, but I think this is applicable to all couples and along different, you know, dynamics of personalities, really. But, you know, if you are the financial person in your relationship, and there's one, sometimes there's two, but usually it's one or the other. And I think that, you know, it's kind of a good idea to talk about that with your spouse or your partner, to say, okay, you know, I handle the bills or you handle the bills. But regardless, I think both people should be involved in those longer term planning conversations. So if let's say it's partner A that handles the bills and handles a lot of the finances, partner B should still be encouraged to come to those meetings, to be CC'd on the emails from the financial advisor. They may not want to, and it may take some persuading to encourage them to kind of participate. But I do think it's important because, you know, I think the head in the sand mentality is fine to a certain extent, but when you're talking about those longer term goals or accomplishing those longer term goals, I think both partners would want to be on the same page. And you know, I think, again, just coming from the point of view of a woman, you want to know, you know, because God forbid, what if your partner passes away? You want to know who do I turn to? Who's the person that can help me navigate all of the things that are going to come now that I'm the one who's in charge by default. Excuse me. So back to, again, I think those life transition moments, you know, death or divorce, disability, things like that. I think having an advisor that can educate you along the way, so that, God forbid, one of these things should occur, you know what to do, you feel okay, you have some baseline level of confidence. I think that's really important in being in a couple and having that couple dynamic space. So some red flags as you're interviewing financial advisors. Some of these might be obvious, but good reminder: somebody who's ignoring you or your questions. I've seen a situation where a couple was interviewing a financial, or they told me that they had interviewed a financial advisor. Both of them went to the meeting, both of them emailed the advisor, but the advisor talked to the man only for the entire meeting, didn't even really acknowledge that the woman was in the room. So clearly that's a huge red flag. Again, I think, you know, back to the last slide, there are times where there is a you know, primary decision maker or core contact, I guess, in the relationship, but somebody who's ignoring you that's a big red flag. Somebody who doesn't explain. And I think this is another red flag that can come up with maybe overly complicated financial products, or throwing out financial terms without explaining them, using a ton of acronyms without going into what those acronyms mean. You know, sometimes that can come with a little bit of maybe a pompous attitude of wanting to show off some of their knowledge, which, you know, as a chartered financial analyst, there's a lot of studying that goes into having that designation. And, you know, there is a lot of, you know, the certified financial planner designation, and another one that it's a lot of studying, but there's no need to not explain things. I mean, that's really what the financial advisor's job is to break it down to the layperson who, again, this isn't their day job. So someone who doesn't explain would certainly be a big red flag. The suitability standard versus a fiduciary standard. Anytime that you are interviewing a financial advisor, probably one of the very first questions you should ask is, are you a fiduciary? Meaning, are you held to the fiduciary standard? What that means is an advisor who is held to that standard is required by law to always have the client's best interests at heart in everything that they recommend. In my opinion, that should be a law for anyone who's giving financial advice. However, it's unfortunately not the case. The alternative is what's called a suitability standard. What that means is an advisor who is not a fiduciary can recommend a product to a client, even if it's not in their best interests, as long as they can justify that, hey, this is suitable for the client. It's a very, very important distinction because, again, I cannot believe that this is not a law, but only a advisor who is a fiduciary is held to that standard. So that should be number one question that you ask. Sometimes, this, I think the classic example is probably somebody who might be selling an insurance policy that they could justify as suitable, even if it's not in the best interest of the client. And the reason that someone might do that is that they're collecting a big commission on the back end, which goes into the next red flag here. I think at our firm and at what's the term is a fee only advisor. In that case, there are no other fees that are collected. It's just a percentage of the assets that are managed. And that compares to someone who might be collecting commissions. The reason that our firm has always said we do not collect commissions, or that's a business model, is that we want our clients to know that if we're recommending something, whether it's an estate planning tool or an insurance product, we want them to know, hey, this is in your best interests. We're not collecting any commissions for recommending this to you. So that's often that's termed a fee only advisor. So that's another question to ask as you're interviewing potential advisors is, are you a fee only advisor? Excuse me. Doesn't offer a high level of service. I think, again, this goes back to what's important about working with a financial advisor. I would recommend seeking out somebody who goes the extra mile to offer that high level of service, that holistic planning, rather than having somebody say, okay, we'll be happy to manage this one account for you, but really don't want to get involved in smaller accounts for your children, or, I can't manage your 401k account at your work, so I'm not going to do much there. It's just going to be this one thing that I'm managing. I would recommend finding an advisor who does offer that level of service, because I think it goes back to being able to proactively suggest things to the client, or kind of have their long-term goals in mind as they're giving advice and guidance along the way. Finally, this last point here, taking custody of funds. I would absolutely recommend finding an advisor who does not take custody. So essentially what that means is an advisor who works on limited power of attorney, managing your account at some third-party custodians, whether it's Charles Schwab or TD Ameritrade or Fidelity, or wherever it's custodied. The reason that I would recommend this or say that someone who takes custody of funds would be a red flag is so that you don't have the possibility of the Bernie Madoff situation, which I'm realizing now is quite a long time ago, about 15 years ago. So for maybe some of our younger attendees, Bernie Madoff was running a Ponzi scheme, and he was, posing as a financial advisor, but was essentially able to get away with it because his firm was taking custody of the funds, and so all of the statements were falsified. That's impossible to do when you have a third-party custodian, like I said, Charles Schwab, for example, because you can get a statement from Charles Schwab, a statement from your financial advisor who's operating unlimited power of attorney, and you can verify that there's no funny business happening here. So I think some tips on kind of how to prepare for interviewing a financial advisor, or perhaps you've selected one and you're ready to meet with them. I think it's crucial to come to the meeting with questions. And again, there's no question is dumb. There are no dumb questions. It's I think important to go back to what I said about putting your shame aside. Just know that you are not the least informed person. There are plenty of people who do not do, financial management for a living. And so come to the meeting, ask all of the questions, ask the advisor to go into more depth about something that you don't fully understand. And I think that's sort of a good test of, is this a good advisor for me? Do you understand the explanations that they're giving back to you? Are they able to break it down in a way that you feel satisfied with the answer? You feel like you understand it truly. And I think, again, knowing what you want out of that relationship with an advisor. Is it knowing that you're on track to get toward retirement? Is it, knowing how to help your kids financially in the most tax efficient way? Is it building some kind of longer term legacy that you want to establish? I think that it's important to tell an advisor, hey, these are my goals. This is what I'm working towards. How can you help me do that? So final thoughts. What are my final thoughts? I think, women as a group are, like I mentioned, they're poised to inherit or start to control a majority of the wealth in the next probably 10 years or so. Not just from living longer, but women are, more frequently becoming the primary breadwinners and are kind of taking control of those financial reins. So I think, again, back to the statistic that only 15% of advisors are female. As you start to seek out a relationship with a financial advisor, it still might feel like, hey, I'm trying to now enter a male-dominated industry because, hey, it's a male-dominated industry. So I think keeping in mind that, you have these goals, you want to work toward those goals. Your goals are important. And, going into a meeting with an advisor kind of ready to lay all that out. I think having all of those those kind of bullet points that we talked through on these slides, I think is a really, good setup point to start interviewing an advisor who can make sure you're on track to achieve those goals. I guess those are my final thoughts. Marcia, anything else that I've missed or that you could you think through?
Yeah, actually, we do have some questions here. And so this is the perfect time for us to talk about these questions. I will remind our viewers, if you have not put a question in and you have one, go ahead and put that in the chat, and we're happy to address that during the time we have right now. Okay, this is a great question. So what about, have you seen that some women are too cautious or too risk averse in that they will not be able to meet their financial goals, such as like running out of money for retirement?
Yeah, that's a great question. I think as an advisor, we tend to take somebody's personal risk tolerance into account along with all of the other factors. So for instance, somebody might be, let's say there's a 35-year-old person who has a retirement account, and they might come to the meeting and say, well, I'm extremely risk averse. I really don't want to take any risk. The response back might be kind of a conversation of, okay, here's what the risk of the equity market entails versus something like the fixed income market. And there might be some kind of coaching there to say, I completely understand that you have a very low risk tolerance, and I will take that into consideration. What I would advise in this particular account, which is something that has a 30-year time horizon, is that you can take a little bit more risk here because, we don't know what the stock market is going to do over the next 12 months. It may be up or it may be down, and maybe not necessarily in that order. But I have a pretty high level of confidence that over the next 30 years, the stock market will be higher. So I think that there's definitely coaching involved. Now, of course, at the end of the day, if a client says, nope, absolutely not, I refuse to take on that risk there, we can say, that understood. Here's what the cash flow picture looks like. Here's what the asset projection looks like, given that asset allocation that you're suggesting. So I think that's definitely come up. It just requires some coaching and some kind of framing of that risk. Because once people, I've certainly talked to people who kind of are on the much lower end of the risk tolerance scale, but as soon as I kind of remind them that this is the time horizon of these funds, they won't be touched for a very long time, there's generally an acknowledgement of, okay, that makes sense. I'm willing to take a little bit more risk in this account and maybe balance it out with less risk or a lower risk profile on maybe their taxable brokerage account, for example. But that's a great question.
That's funny how you said that, because what I'm thinking is that there is an inherent risk in the longevity of women.
Yeah.
And so you have to manage that risk as well, even though it's not maybe a risk associated with an investment.
Mm-hmm.
It is a risk of just being someone who lives a little longer.
Right. Yeah, exactly.
All right, we got another question in here. If you want to change your financial advisor, is it easy to do?
It's quite easy to do. So I think, depending on the type of account that your current advisor is managing, I should say, I guess this is very, very generally speaking. But for instance, somebody who might be working at a company that has a sponsored plan, whether it's a 401k or a 403b or a company sponsored plan, that's often not easy to change advisors on until you leave that company. That's kind of the one caveat I would say. For any other type of account though, it's quite easy to change financial advisors. I think the process that it generally entails for most most customers that we've seen, most prospective clients, is once the client says, okay, yeah, I want to change, I want to work with you, there's a lot of paperwork, but that can be done on the new financial advisor's end. Generally I would say, as a courtesy to your current financial advisor, just telling them, hey, this isn't working out, or I'm decided to make a switch, going to be leaving. That's usually the best practice to kind of make the transition as smooth as possible. But yeah, I think it's very easy to do. One other, I guess, piece of the puzzle that I want to throw in here, I think especially for this is more specific to taxable accounts, just being aware and maybe asking the financial advisor that you're interviewing, the new financial advisor. You may, for instance, be working with I'll say advisor A, and advisor A might be managing the account and there might be large unrealized gains. I think if financial B is the new advisor that you want to go ahead and switch over to, it's important to ask financial advisor B, are you going to be sensitive about those unrealized gains that I have in my account? Essentially, what you want to avoid is changing financial advisors and then having the new advisor sell everything and create a huge tax bill for you. I think that's maybe the biggest maybe caution I would say, or question that I would ask. And without knowing a particular situation, I don't know that I could speak more in depth, but that's kind of what comes to mind, I think, in terms of transitioning over. But it's generally something that the new advisor can assist with. And I think a good financial advisor is not going to sell everything and create a huge tax headache for you.
Yeah, so is maybe a question you can ask is, what are the tax implications of us doing this? Like, what was my tax bill going to look like?
Exactly.
I know, but in my own experience, when I went to my current advisor, we decided to do a rollover and they're like, okay, that you're going to have a tax bill on these we converted everything to a Roth that I had in a certain account. Like, yep,
Mhm.
I know.
Yeah.
So that, that was something that was a major point to make sure that I was aware of. So
Yeah. Yeah. And I think, making sure the new advisor understands the ins and outs of your situation, and, asking those questions about what will this look like? Do I need to change custodians? Am I moving from Fidelity to Schwab? It's not hard to do. But, having those questions just so you have your expectations are managed as far as what the switchover will look like.
yeah, really good question. Thanks for asking that. Here's another one. Can you talk a little bit about maybe a new partnership or a new marriage and working with, say, you got remarried and your new husband or your new spouse's own financial situation, how you combine that with yours?
That's a really good question. There's a lot of different directions that I'm thinking I could go with this answer. I think in this case, there are lots of other dynamics that might come in here, like, children from previous marriages, or, alimony, or, there are a lot of different moving parts here. I think probably an important step in this process would be to get on the same page with your new partner as far as your finances. Are there certain things that you want to keep separate as you combine your lives together? It might. We always recommend anyone who's getting married or remarried investigate whether or not it makes sense to do something like a prenuptial agreement. Because that can kind of eliminate any further headaches down the road if things don't work out. But I think, getting on the same page with your new partner and saying, here are my financial goals, here's my financial situation. How are we going to, be splitting up bills or paying for large expenses? Does one partner work and the other one doesn't work? And how does that dynamic, play? I think, again, with remarrying, or getting into a new relationship, making sure that the beneficiaries on your retirement accounts are correct. Who do you want the beneficiaries to be? You probably don't want it to be your ex-spouse. So making sure that it's your children, or if you want it to be your new spouse and then your children. I think that's sort of an important thing an advisor can also help with. But I think, again, just back to the original advice, I think most important is get on the same page about financial goals that you have with your new partner. Explain those to your financial advisor, and then your financial advisor can, find opportunities in terms of what makes the most sense from a, separate property versus community property aspect. What makes the most sense from an estate planning aspect? What makes sense from a tax planning aspect? I think that's all the financial advisor's job, and they're best able to do that when they have a clear picture of what your goals are.
All right. So you talked about purpose and financial goals. Can you give just some examples that you've seen in your own experience? I mean, I'm not really sure we gave any examples there.
About financial goals.
Yeah, what are some typical financial goals that people come to a financial planner or advisor about?
Yeah, I think retiring is a really, really big one. And maybe before that, probably paying for college, or kind of thinking through different ways to pay for college for children, or planning large expenses. I think just kind of picking on the paying for college one. I think I can get into a little bit of depth there. And actually, there's the very obvious thought that comes to mind for most advisors, and it's probably honestly a good fit for most people, is opening a 529 account for a young child who's ultimately looking to use that for college. And that might be perfect for you. But where I think a financial advisor can really help think through whether or not that makes sense, and kind of the planning of the timing of inflows into that account. Because there are kind of caveats to the 529. You have to use them for educational funds. So there is sort of a danger of overfunding a 529 if a child gets a scholarship or something. It doesn't need to pay for college. There are other things you can do, like kind of switch it over to a new beneficiary. But I think there are also thoughts about estate planning that may come into play. And what I mean by that is, couples who right now there's an estate tax threshold. It's very high right now. It's $11 million per person or 22 million per couple. But it's expected to be cut in half by 2025. So and we don't know what the tax laws will do. So there's a little bit of kind of handicapping and trying to see into the future here. But for a couple who might be above that estate tax threshold or might be projected to be above that estate tax threshold, a 529 really doesn't make any sense because realistically, they should be paying for college out of their taxable estate to reduce that amount, because that's one of the only things that you can pay for somebody else without it being considered a gift by the IRS. Excuse me.
That's very interesting. Well, we have time for one more question, I believe. This is a good question. How close do you need to be geographically to your financial advisor? Do they have to be in your same state? Can you talk a little bit about that?
Yeah, great question. Sorry about this. I've got a tickle in my throat. So I would answer this and say the pandemic has changed that completely. And virtual meetings, I think every advisor has a different style. We really like to meet in person with our clients because we think that things can be missed in virtual meetings. And it might be as simple as, you go to see the client at their home and they say, oh yeah, I'm planning a landscape project that's going to be $50,000. And it's like, oh gosh, yeah, that didn't come up in the virtual meeting that we had. So I would say that a financial advisor can be anywhere. And, I can speak from the experience of our firm. We have clients kind of all across the country. Many sort of have some kind of original tie to the Bay Area, but a lot of them don't. And we will travel to see our clients because, again, I think it's important for us to really gain that deeper understanding that we feel is best achieved in person. So it might be easier to do a quick pop in to a financial advisor who's local. But we certainly work with clients all over the country. And I think especially younger generation it tends to be comfortable with virtual meetings in the interim. So I think that there are tax laws that differ state by state, but that's only a piece of the puzzle. And often a financial advisor is kind of the quarterback who then is the liaison with your accountant or CPA or estate planning attorney who, the state laws are kind of siloed in that regard, but the financial advisor can work with those experts that you've hired for those specific services, and they can be from anywhere.
On behalf of Advice Chaser, we want to thank our speaker and the organizations that have worked with us to bring you this webinar today. Thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.